Normally when gold tops, and by the way, we got bearish 3 months after the high in 2011. In January 2012, we turned major bearish on gold. It labored. Now, it made a high at 1,920 in October of 2011. Dropped down to the 1,600 zone, 1,700. And we got bearish, and it went sideways for that year, 2012. Up and down, sort of like the teasing stock market. It just wouldn't go down, yet we stayed bearish.
Yeah.
It tried a couple times to make a new high, went up to the high 1700s. We never could get back to that high. But annual momentum had broken a massive trend structure shortly after making the high in October 2011. Price didn't break anything at that point after that pullback, but momentum blew a structure that your jaw would drop seeing the clarity of it. Okay, it's first off, the concept of a single global reserve currency is kind of silly anyway. Why?
Something big is about to shake the silver market, and this time it's not just speculation. Analyst Michael Oliver, one of the most respected momentum forecasters in precious metals, warns that the bullion banks are preparing a coordinated attack on silver next week. But here's the twist. The entire setup is happening while the US dollar's long-term structure is breaking down. Treasury yields are flashing stress signals, and gold prices are holding near all-time highs above $4,000 an ounce, even after last week's $300 pullback. Meanwhile, silver is hovering around $48 to $49, refusing to break despite heavy paper shorting on COMEX. That resilience, Oliver says, is exactly what precedes a massive upside revaluation, and the banks know it. They're trying to shake out weak hands before the next leg up begins.
I could see why, back when you had ships that crossed the ocean and that's the way you transported messages and money, it takes time. But now within a second, you could move money here to there. So why do you need a reserve currency, a single one, especially in a country that's got a troubled debt market, okay, just like Japan? Why not have multiple units of exchange? And sure enough, it's happening. Okay, doesn't have to happen officially; it just happens. Market forces cause it. I think it's underway. A bear in the dollar, but you got to remember the dollar we're talking about is not the real dollar, the thing we use in our wallet. We're talking about dollar versus the yen, dollar versus the euro. Those two currencies are 70% of the dollar index. So when we talk about the dollar index, it's mainly euro and yen, okay?
Yeah.
And so, yes, the dollar is, I think, in a bear trend versus the other fiat currencies, also unbacked paper.
Yeah.
And right now it's trading the drop to 96 in this overall drop. We got bearish at 104 in March. It came down to 104. Collapsed through the obvious level around 100. Got down in the 96.7. It's been 6-7 months now of just this. Between 96 and about 101 something. Right now we're trading 99 or something. So it's really not going anywhere. It's just languishing. Annual momentum of the dollar, when we measure not just the price, but measure it versus its 10-year average, create an oscillator, its 3-year average, create an oscillator. They both had trend structures that an idiot could see. Broken, fully broken. The backbone of that market is broken. Therefore, the only issue is, when does it produce the next leg of decline? I think you could challenge that 70 level on the dollar index we saw back decades ago. Yeah. Right now, it's 20 points below here. It's a major drop. But as you said, in the process, there's more going on here than just the dollar dropping. Now, the dollar has not been a factor in the markets between 2023 and 2024 because the dollar index was dead. It was in a range between 100 and about 108. About 7-8% range, just up, down, meaningless action, while other markets were fairly dynamic. Now suddenly the dollar has broken the backbone of its prior momentum bull trend. And so it's suddenly become, instead of the silent one, now it's a player, and it could impact other markets. I mean, think about it. If you're European and you're invested heavily in the U.S. market, as many Europeans have been recently, it affects you. Not just what the S&P does, but what the dollar conversion does.
Yeah.
If it's going down 10% and S&P is going down 10, you got double kicked. Okay, so it's an important factor, and it's come into play now as opposed to not being in play for those couple years. The Treasury issue is the other time bomb. It's a huge one. Okay, we know that. Okay, it is in Japan and here. And by the way, I'll point out that the woman who just got elected in Japan was, for them, extreme right. In other words, she was like a Trumper, and in fact, got elected there. And she, now think about this. You have a segment of a political system that is, quote, conservative, right? Supposedly pro-free market. Her solution was print, 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 is what she said. Okay. Now, we know that President Trump wants the Fed to print, 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 and to take rates to, wherever they need to go, zero. He even said that back when he was president first time around. Yeah. So he wants rates artificially low and money supply to grow to compensate for, to help support the bond market. Yeah. Fed buy this stuff, okay? And she said the same thing. So you even have the conservative elements in these two countries advocating inflation, because inflation is the increase in the money supply. And that's where we're headed. Gold knows that. Gold knows there's not going to be an alternative other than that, especially if you start breaking any financial institution, especially if Bitcoin collapses and suddenly causes some horror nightmare stories that aren't directly coordinated to Bitcoin, but are connected to major companies. And emotion comes in. The Fed's going to cut even before he leaves, and he leaves, in January or something, becomes just a Fed participant. Trump's going to get what he wants. Now, and that's not going to be monetary restraint, okay? So ultimately, that's negative for the T-bond market in that, it's more of the same. T-bonds, technically, here's the technical view. We got bearish in October 2020. It was 170 on the 30-year T-bond futures. They collapsed into 2022, got down near 100. And if you go sideways, since their low, I think the actual low was in 2023, slightly lower than the 2022 low. Draw lines sideways on price, or if you're looking at a yield chart at a high level, nothing is happening. Fed rate cuts, Fed rate rises. T-bonds don't care. They're in their own world, and they're dead. When I look at that price chart of T-bonds and its momentum, long-term momentum, I see the potential for a basing action, which when you see something go down hard and you see it go sideways for a long time, you think that's a base, right? Okay, maybe it's a buy. Mm-hmm. It's had multiple opportunities to engage out of that base, technically. Each time it's tried, it got up into the 120s on T-bonds after being down toward 100 and 110 especially, is a level it's sought recently. And it fizzles out and slumps back down again. We are now in our third rally effort since the bear low, momentum's third rally effort. That's all you get. If this one doesn't take hold, and the factor that would maybe help cause it to go up, yields go down, is the stock market breakage. Finally, it becomes the alternative 40% of the equation. Yeah. It hasn't worked. Maybe it'll work this time. I would say that if you get T-bonds right now are at 118, T-bond futures, you don't want to get back down much under 116 even. And if you ever see something like 111, expect a surprise mini crash type event in the T-bonds. That is the kind of event that if it should happen, they're going to panic. I say they, we know who we're talking about.
The Fed.
Yeah, and Bank of Japan, and because they're all in the same soup. Mm-hmm. Anyway, that's one of the also big, huge pieces of dynamite out there that is dead for now. It's not engaged. It's not helping in any way because its yields are still high. But if it ever engages for one more spike down in price or spike up in yield, the policy consequences will be enormous.
Michael Oliver's warning is rooted in momentum, not hype. In 2011, gold hit $1,920 before collapsing, and Oliver's momentum models turned bearish months before the price did. Today, he says, the situation is the reverse. Momentum in both gold and silver remains strongly bullish, and there are no structural breakdowns anywhere on the long-term charts. The US dollar index has fallen from 104 to below 100, breaking multi-year support. Oliver believes its momentum backbone is broken and could eventually drop toward the 70 level, a fall that would force investors and nations to abandon the dollar as the single global reserve currency. At the same time, Treasuries are a ticking time bomb. The 30-year bond has gone nowhere for months, with yields stuck near cycle highs. Even conservative governments, in both the US and Japan, are now openly advocating more money printing and lower rates to protect debt markets. That means inflation is not going away, it's being guaranteed. Oliver argues that this shift will transform gold and silver from traditional safe havens into monetary anchors. In his words, we're heading toward a reality where governments themselves may eventually reprice gold at $10,000 to $15,000 per ounce, and silver at levels few investors can imagine. And as commodities start waking up, after years of going sideways, the setup mirrors the late 1970s explosion when stocks crashed and hard assets went parabolic. Gold, silver, and mining stocks are quietly preparing for their strongest move in decades.
As far as the monetary metals, I don't see anything. I think they're going to a new reality and just going to level off there, and suddenly gold is going to be priced by this government or that government at $10,000 or $15,000 an ounce, and that's their currency, et cetera.
Yeah.
And silver is going to be at some level that you're not thinking about right now. Maybe we've discussed the lower end of it. And that's the reality. They've gone up. Gold goes up when the stock market collapses. There are rare exceptions, a month here, a month there, but in big trends like 2007 to 9, during that period, gold went up and continued up to 2011. The stock market is still laboring. Okay,
it crashed initially. But then it rebounded.
Well, in October of 2008, there was a crash month.
Yeah,
gold joined that month, but within 3 or 4 months, it was back to its high. Well, the S&P was making new lows. Okay, so net, not month to month, but look at the bigger trend. Gold was rising from 2001 to 2011, despite that interruption in October 8. Okay. Silver as well. Gold and silver miners as well. Go back to 29 to 32. That's Dow Jones dropped like 80%, okay, in that period. Most of its slow part between 1930 and 1932, not the crash in October of 29, but most of it was a slow bear market, but arduous, an 80% drop. During that time, there was no gold. It was illegal. Okay.
It was fixed,
Homestake mining went up 1,000%. Okay. Gold miner, big gold miner. Same in 2007 to 9, gold rose. 2000 to 2002, gold was rising all during that time. No, it didn't explode till later.
Yeah.
But it was going up while stocks were going down. And look what happened just this year. January to April, S&P went from a high to a low, sharp drop, about 20%, I think it was. Gold was rising sharply all during that time, January through April. When the stock market made its low in April, gold made a high. It didn't drop. In other words, you can say, well, if it's opposite the stock market, gold should have dropped when the stock market went up, but it didn't. It said, no, I'm going to hold my own for 5 months. Went sideways. They sold it and they sold it. Couldn't get it to go down, though. But stock market rallying, and then now gold is engaged again. Now, I'm going to bet you're going to see stock markets start to de-engage. Now, the argument that you're going to deflate depends on what you define as inflation. If you define it as we do, monetary expansion, then don't expect it. Don't expect, quote, deflation. Look at the M2 chart. Don't expect it to go down. Okay. Now, if you look at a given asset that was bloated too high and it goes down, yeah, we could call that deflation. But during that same time, better watch out for commodities, because commodities are poised now after their sharp run-up in 2020, 2022. By the way, they peaked 3 weeks after that war began. The war didn't take them up. They peaked right after that war. Commodities pull back about halfway of the move between 2020 and 2022. Bloomberg Commodity Index has gone sideways, either side of 100 for 2.5 years. It's like it's asleep. Just won't go down and won't go back up. It's toying now with an upside breakout level on our momentum that says another leg up is about to start. Now, commodities often will go opposite stocks in a bear market. Look at the late 70s. Global recession, stocks down, wasteland. Commodities exploded on the tail of gold. Followed gold up. They were lagged to it and they didn't do as well, but they went up. So you can have, quote, deflation in certain assets, but look at money supply and tell me if it's deflating. And then, two, look at certain other assets that weren't overvalued, like commodities. Right now, the Bloomberg at 105, for example, is that high? Well, in 2008, it was 237. Okay, we're not even half what we were in 2008. Okay, 105, 237 then. And in 2011, it made a high at 170 something. So no matter where you look back, commodities aren't high. And we're betting they go up during the monetary expansion. Money moves from one to another. If you're a major portfolio manager, you're not a gold bug, let's say, you just look at what's doing well, okay? And your buddy down the street, his firm, they're doing well because they shifted more into commodity-related stocks, especially gold-related, which are up vastly more than the stock market, okay? And that's not only just true for this year, but you can go back several years and they're beating the stock market. Oh, by the way, another point on that. You talk about inflation, and deflation. If you go back and you're trying to make money as an investor, meaning an investment lifetime, let's call that 25 years or so. If you bought the S&P this month in the year 2000, 25 years ago, you're up 4.5 times your money current S&P price. Okay, money supply is up a bit more than that. So you're only keeping up with the growth in M2. Okay, gold is up 16-fold.
Yeah,
16-fold from where it was in 2000. You talk about holding value and making money. Really money that you spend and buy things with. There's no comparison, and yet the public is, like you said, frothy about that which is only kept up with the money growth. Normally, when gold tops, and by the way, we got bearish 3 months after the high in 2011. In January 2012, we turned major bearish on gold. It labored. Now, it made a high at 1,920 in October of 2011. Dropped down to the 1,600 zone, 1,700. And we got bearish, and it went sideways for that year, 2012. Up and down, sort of like the teasing stock market. It just wouldn't go down, yet we stayed bearish.
Yeah.
It tried a couple times to make a new high, went up to the high 1700s. We never could get back to that high. But annual momentum had broken a massive trend structure shortly after making the high in October 2011. Price didn't break anything at that point after that pullback, but momentum blew a structure that your jaw would drop seeing the clarity of it. Okay. At the bottom, 2015, price had already collapsed, but was still staircasing down at a more gradual level on gold and silver and the miners. But momentum had built a huge ceiling, annual momentum, that was so clear that it wasn't clear on the price chart because it was lower highs, but a momentum was like a ceiling at the same level for 2 years. You popped through it in February of 2016, after the 2015 low.
Yeah.
And you exploded up to 1,300. So you started the bull market. The structures were near the market when it turned both of those times. That's the point I'm making. There's no structure near where we are now on momentum that says if you have a drop of $200 in gold or 500 or anything, you're not even near any.
Yeah, you're so far above the line.
Above any momentum vulnerable structures that say it's over. Momentum almost always will break a clear structure before you see the evidence on price. Right now, we don't have that situation. I'm betting by the time you get the structure close to the market, meaning where the momentum factors come up under the feet of the market, we're going to be at some level that you could throw a dart, but we're not near that. So there's nothing that I can see on long-term momentum that says you got any problems. It's the other way around.
Right.
If you're a doubter and wanting to take profits, you got a problem.
Michael Oliver's message to precious metal investors is simple. Ignore the short-term noise. Momentum is on your side. Every time bullion banks attack the paper market, it only tightens the physical supply and drives the next leg higher. The dollar's structure is broken, the Treasury market is exhausted, and the world is shifting toward hard money once again. So the real question is, will this coming attack push silver down temporarily, or trigger the breakout that ends the paper control era forever? What do you think? Has the banking system lost control of real metal prices? Drop your thoughts in the comments. If you found this analysis valuable, hit subscribe and turn on the bell so you never miss a Metal Watch deep dive. We're tracking every move, from COMEX manipulation to central bank gold flows, so you'll always know what's really happening behind the headlines.